Hello everyone, welcome to Business Education and Research. This video explains the concept of operating leverage with a practical example. Operating leverage is a financial concept that refers to the extent to which a company's operating costs are fixed or variable. It measures the sensitivity of a company's operating income to changes in its sales revenue. In simple terms, it helps us to understand how a company's profitability is affected by change in sales volume. Operating leverage is an essential concept for both businesses and investors because it can significantly impact a company's financial performance, risk, and valuations. We will discuss operating leverage in detail, including its types, importance, and implications. This type of leverage arises from a company's fixed operating cost such as rent, salaries of permanent employees, depreciation on machinery, and insurance. These costs do not change with fluctuations in production or sales. As sales increase, fixed costs remain constant, which can lead to a higher profitability of a company. This slide shows the calculations of operating leverage. Operating leverage can be calculated with the following formula. Q represents the quantity of units sold or the unit sales volume. P represents the price per unit. V represents the variable cost per unit. F represents the total fixed operating cost. Now let us see the calculation of operating leverage with an example. Suppose you run a small wooden furniture manufacturing company that produces dining tables. You have the following information for your company. Quantity of dining tables sold, Q, that is 1000 units of dining tables. Price per unit of dining table, P, $20. Variable cost per dining table, V, $10. Total operating fixed cost, F, that is $5,000. Now let us see the calculations of operating leverage. This is the formula. This is the formula to calculate operating leverage. So now let us apply the formula for the given information. Operating leverage is equal to 1000. 1000 is what? 1000 is the quantity of dining tables sold, Q, this Q. 20 minus 10. What is 20? Price per dining table, selling price per dining table, that is P. P is equal to 20. V is what? Variable cost per dining table, that is 10. Whole divided by Q, that is the quantity of dining tables sold, 1000 units. P is the price per unit. V is equal to variable cost per unit. 5000. What is 5000? 5000 is total operating fixed cost, 5000. So all the informations are available in the formula, in the question. Whatever required for the formula is available in the questions. So by applying the equation, you get the final answer as 2. So the operating leverage of the company is 2. Now let us try to understand the interpretations of operating leverage for the given example in the previous slide. In the example shown in the previous slide, the calculated operating leverage is 2. This means that for every 1% increase in sales, that is quantity of dining tables sold, the company's operating income, EBIT, will increase by 2%. Conversely, if sales decrease by 1%, EBIT will decrease by 2%. Sensitivity to sales. With an operating leverage of 2, the company is relatively sensitive to change in sales. Small increase in sales will lead to proportionately larger increase in operating income, which can be favorable in a growing market. Risk. While high operating leverage can magnify profits in good times, it also increases the risk in periods of declining sales. If sales drop, the company's operating income will decline proportionately faster, potentially leading to losses. Break-even point. A higher operating leverage also implies a higher break-even point. In this case, the company needs to sell enough dining tables to recover variable and fixed costs before generating profits. Importance of operating leverage. Profitability impact. Operating leverage can significantly impact a company's profitability. When a company has high operating leverage, a slight increase in sales can lead to proportionately more significant increase in EBIT, resulting in higher profits. Conversely, a slight decrease in sales can lead to proportionately more significant decrease in EBIT, potentially causing losses. Risk assessment. Operating leverage also affects a company's risk profile. High operating leverage means that the company is more sensitive to changes in sales volume. If sales decline, the company may face financial difficulties due to its fixed cost components. On the other hand, low operating leverage implies less sensitivity to sales fluctuations but may limit profit potential. Strategic decision making. Understanding a company's operating leverage is crucial. Companies with high operating leverage may need to be cautious about taking on additional fixed cost as they will be more exposed to downturn in sales. Conversely, companies with low operating leverage may have more flexibility to adapt to change market conditions. The implications of operating leverage. Break-even point. Operating leverage affects a company's break-even point, that is the level of sales at which it covers all its costs. High operating leverage requires a higher break-even point, which means a company must sell more units to cover its fixed cost. Financial risk. High operating leverage can increase financial risk, especially when combined with financial leverage, that is debt. If a company with high operating leverage faces sales downtrend, it may struggle to meet its fixed financial obligations. Investor perception. Investors often consider a company's operating leverage when evaluating its risk and potential for growth. Companies with high operating leverage may be considered riskier but potentially more profitable, while those with low operating leverage may be viewed as stable but limited growth prospects. In conclusion, operating leverage is a critical financial concept that helps assess how a company's profitability and risk are influenced by its cost structure. It is important for businesses to strike a balance between fixed and variable cost to optimize their financial performance and manage risk effectively. Additionally, investors use operating leverage as one of many factors to evaluate the attractiveness of an investment opportunity.